Hey there, Brian Bogner and Greg Towner here, and we want to take a few minutes, of course, and talk to you about what's going on in the market. Look, if you're breathing right now, you probably know that the market is been going down, and this drop is certainly a gut check. It doesn't feel good. There's a lot of emotions going on right now, so let's go ahead and get into some slides here and some of these bullet points, and we're going to try to hopefully bring some perspective to what's going on here. Okay. Uh, I'll go ahead and start here. This is just the S&P 500 going back 5 years. And again, just wanting to bring some perspective, even with this steep drop that we've seen, and this includes today, this Monday, where, it's been down around 6%. Over the past 5 years, yeah, you've had some volatility, not a lot actually, a little bit at the end of 18, 19, but you're still up 35%. Okay. Now where's this going to go? I don't know. We don't know, but trying to keep some things in perspective here. We're fielding some calls. People are acting like they're losing everything. Well, really, all we've lost is where we were last summer. So the last 9 months have been eroded in market value here, but we still got, there's still been some positive movement there. Greg, you want to add anything?
Yeah, I think the thing that I would add, Brian, is, as painful as these types of corrections can feel in the moment, when you look at really longer term charts, it's sometimes even hard to find them on the chart. And then you certainly can't remember what each correction was about in hindsight. At the moment, it feels
I,
like everything is the worst. But you go back even in just recent years, and even those of us in the business sometimes have to really think, now, what was that correction about again? It's just, it
yeah.
comes and goes. That's unfortunately
You know,
part of
it,
it.
it's funny you say. Well, it's not funny you say that, but I remember this correction in 15, and I remember the beginning. I remember the beginning of 2016 when we were in that deflationary kind of spiral. And you look at it now, and had we sold and gotten out, and again, we're getting a lot of questions. Oh, sell, and this and that, and we do have some things in place, but you just don't know. Well, when do you if you get out of everything,
Right.
when do you get back in, right?
Exactly.
And so I was even debating whether to put a 20-year chart or something like that on here to show exactly what you're talking about. But look, we're here. It doesn't feel good. Okay, so this is stocks, right? And what's the second thing right now? Our interest rates. Okay, so what's going on there? Well, we're seeing a huge drop in interest rates, right? Because really, what's happening is money is coming out of riskier investments like stocks and things like that, and they're going into risk-free investments like treasuries. And so treasuries, this is the 10-year note, right? When this goes down, it's inverse of prices are going up. So all this money is just piling into bonds right now. And right now, the U.S. government is going to pay you 0.5% for the next 10 years if you buy one of their bonds. You tell me if that's a good deal.
Yeah,
So from an investor yeah, go ahead.
yeah, I was just going to say, we recorded a video only about a week ago, mostly about interest rates. And at that time, the 10-year was right around 1%, just over. Now the 30-year Treasury bond is 1%, actually just under. So now you can loan your money for 30 years and get 1% per year. Meanwhile, the yield on stocks is now at the highest relative to bonds, to the 10-year, going all the way back to the 1950s. So yes, there's a lot more volatility in stocks, and it has to be longer term money. But if you have that kind of time frame, are you going to get substantially higher yield in the stocks? Forget about the potential gains over long term. Just the yield is substantially higher.
And just going back here, and I know we're going to take a little bit longer than we normally do on these calls. We try to keep these calls around 5 minutes, but we're just going to take a few extra minutes because we think this is really important to talk through some of these things. This is just going back 5 years. I mean, if a client comes to me and says, Brian, I want to invest money for the next 5 years, we're not buying stocks because, if your time frame is only 5 years, then stocks isn't appropriate. So we have a much longer time frame when we own equities, okay? So where does that leave us? All right, let's kind of bring this down to what that means for you and I, all right? Well, first of all, uncertainty and emotions are ruling the day. Look, we haven't even mentioned the word coronavirus yet. We're mentioning it now. But the reality is we just don't know, and it's creating a lot of fear. And so when people start making investment decisions emotionally with all that fear, right, what are they doing? They're just buying something safe or just moving their money or getting out because they're scared, okay? And right now, that's what we're seeing. Emotions are ruling the day. Emotional movements in the market tend to be short term. They don't tend to be secular or fundamental shifts or, oh, okay, something's changed now. Now this is going to be different, okay? The reality is these companies, they're not going out of business. Now, do we think there are some companies that are out of business? We do, actually. And I won't get into that specifically, but in the energy space, some leverage, small companies right now with the drop in oil prices, you know, there very well could be some. But the high quality investments, you know, they're not, you know, on the border of filing for Chapter 11 or something like that, or Chapter 7. They're you know, they're realizing, hey, there's some disruption here. Okay, people aren't doing what they're normally doing because of this virus, so we're going to have to adjust some things, and the market's just going boom as a result of it. And so what we want to do is take a step back always and say, okay, yes, this stinks. This is a gut check, and this hurts right now, but these disruptions are likely going to be temporary. Now, if you ask me how long, month, 2 months, 6 months, I don't know, but they will. Like we feel pretty confident that they will be temporary. And some silver lining here, gas and loans are cheap. I mean, go to the pump. Gas is cheap right now. This is extra money in people's pockets, right? I heard someone the other day for a particular bank, like there was a hour-long hold on their refinance line. People are refinancing their loans. Well, guess what? If you refinance your loans, that's more money in your pocket. People are actually able to save some money here going through what we're going through right now.
And some other key points to consider is, you know, long-term saying of don't fight the Fed. Well, the Fed did a rate cut last week. They have a meeting coming up next week. They're probably going to cut then, if not before. Other central banks are easing. You know, of course, there's only so much they can do with the immediate concern around the virus, but they're trying to stabilize the economy. But what we're looking at is past this shorter-term crisis period around the health issue. The Fed's not going to be all of a sudden raising rates. All that stimulus is going to stay in. And when you have stimulus and liquidity, it can be really strong for financial markets. So it may not be a huge help right now and in days like this, but ultimately, as we get past the shock of the crisis, that liquidity will be beneficial. We've been spoiled with low volatility, Brian. I mean, all last year, the market just seemed like stocks were just only could go up. Every once in a while, unfortunately, you know, to get these longer term great returns in stocks, you have to be reminded once in a while that things don't only go up. And then as a reminder, you know, a lot of our investment philosophy can be summed up in our QRLT system, quality, rules-based, liquidity, and taxes. And we'll focus on the first two, quality. You know, we focus on high quality investments. Like Brian said, there's going to be companies that go out of business, but we're not worried about that with our holdings because we start our investment process by screening for high quality. And then rules-based. You know, we talk a lot about the emotional side of investing. If you don't have a rules-based system in place, it's times like these where you might make rash decisions to do something beyond what you should be for your long-term goals.
Yeah, and so let's go ahead and take it here to the end, and this is the real important thing. If you are worried or you're concerned right now about the market, then please call us. We're look, you know, we've got our own money personally invested the same way and in these same things as well. Okay, we're feeling this gut check too. Okay, even as a firm, right? You know, our revenue goes down when the market goes down. All right, so we are right there with you and feeling this as well. Okay, so if you've got a concern, please give us a call. Shoot us an email. We're happy to talk with you. We're happy to go through this with you. We're happy to look at your account. We're happy to do this. We're here with you. This is not a fun time. These are never fun times to go through, but the reality is, just like Greg said, we're going to go through them times, and we're here to go through them with you. So thanks so much for listening, and we'll talk to you later. Bye now.